time for Options Corner. We'll take a deeper look at Palo Alto. Rick Ducat is here, lead market technicians. So you're taking a look at PANW. Good morning to you, Rick. What are you watching there on the chart, please?
We find ourselves at a potential tipping point here because Palo Alto Networks is in the thick of the nearest volume node here, near about 195 or so. And we've also made a repeated ceiling right here at this red dashed line, roughly around 198. So we've so far failed to break out of this area in which we find ourselves right now for the past few days here. If we do break to the upside, those old highs near 207 could come into play. And then the +1 standard deviation channel comes in at about 214. To the downside, another volume node down here, but we've also got our two moving averages, yellow 21-day and orange 63-day, and our two competing trend lines, both around about 187, 188 or so, Nicole.
Yeah, understood. I mean, at this point now, I know you're looking at the options activity. How has that been looking in this particular stock?
Sure. So I looked at the February 21st expiration series, the big call side strikes, 200, 215, and 190. On the put side, it was 170, 180, and 160. So not really any overlap there. And I got to say, though, the major outlier is the September 19th expiration series, though, because the 70 and 67.5 puts have 35,000 and 20,000 open interest respectively. So that really is by far the largest one. Notable trade yesterday was sometimes called a risk reversal spread. This trader bought 100 of the February 21st 200, 215 call verticals, and they combined it by selling a 180 strike put for a 120 net debit, 24K debit versus max profit of 276K. Selling the put significantly defrays the cost of the call spread. And, it was just a notable, interesting trade there because then it can become a cash secured put if it goes down.
All right. Thank you for all of that. Rick Ducat, thank you. Great to see you. Look there at Palo Alto. We continue following this name and we go straight to Tom White, senior options contributor, looking at an example trade for this name. Good morning, Tom.
Morning, Nicole. So implied volatility levels elevated going into this report. No surprise there with the event risk on tap. Option markets pricing in about a plus or minus $15 move in the shares. That's nearly 8% on a percentage basis. Now, the stock has pulled back about $10 from those all-time highs that we saw of $207 a share. So I looked at a strategy that takes advantage of implied volatility levels here. If you think this stock's going to revisit maybe those all-time highs, continue to the upside, Rick mentioned that one standard deviation move around 214 might be in play here. I looked at a bullish call diagonal where I'm going to go out to the February 21st monthly cycle that expires in 8 days, and I'm going to buy the at the money 197.5 strike call. And then to offset some of the costs on that, in the near term Feb 14th weekly options that expire in just 1 day, sell the 212.5 strike call. So a bullish $15 wide call diagonal to the upside. I'm paying roughly about a $6 debit for it. So that's going to be my risk, $600. But it's less than half the width of this $15 wide bullish call diagonal. And why is that? Well, it's because the vol dispersion between implied volatility levels between the option series. So in that February 21st weekly or monthly options that I'm buying the 197.5 strike call, that's about a 75% implied volatility on aggregate in that option series. And then I'm selling in the near term Feb 14th weekly options where I'm selling the 212 strike call or 212.5 strike call. That's about 160% implied volatility. So that lowers the input cost or risk on this bullish call diagonal. Now, where's our break even? My break even is going to be around the $200 level. So you need a move to the upside. This takes advantage of that grind higher. It takes advantage of the different implied volatility levels. But the idea here is if you think this is going to go up about what the option market's pricing in, about that one standard deviation, that 212.5 strike call is going to be the point where you want it to go. Now, because I paid less than half the width of this call diagonal by paying only $6, I've only got one break even. Everything above that is going to be profitability on this trade. But this might be the way you play it if you think we're going to hit all-time highs, again, taking advantage of that vol dispersion that we're seeing with the event risk and earnings coming after the close.
Yeah. Thank you. We'll be watching for that. I know Wedbush is really confident on the deals coming forward in the second half of the year for this company, cloud, AI deals and such. So with a 225 target. Also, Tom, bond yields are falling. Stocks futures are moving higher now after that PPI print. So we'll have a busy day ahead. Thank you.